I was looking at the markets today. Looks like oil was going up quite a bit, and silver, platinum, palladium, especially oil and silver, was moving up quite a bit this morning, and then it settled down. Um, the euro took a bounce. Now, there's a reason for this. Bernanke is actually doing things to support the euro, despite what his statements are, and to me, that's a good thing. It's going to keep the markets up. There's like various schools of thought. I know, I'm aware of it. That everything's going to come crashing down, or there's going to be hyperinflation because they're going to keep printing so much money. I don't think either one of them is true. I think that Bernanke is pretty smart, and he's not going to go overboard with different things. But despite his rhetoric that he was talking about in 2011 on the last FOMC meetings, Federal Open Market Committee meetings, about him not wanting to do any more QE, that's not exactly what he's doing. He is doing more QE in a way, in different ways. Not QA by definition, but he's kind of doing a QE in a way for Europe, despite what he's saying. I'm going to go over a couple articles. This was on Zero Hedge, and this guy, I'll post a link on this, but this guy's pretty much, saying that things are shaping up for a big disaster in the stock markets. And, quite honestly, nobody really knows, because even the great one, I consider the best one, Mark Faber, he says there's going to be this catastrophic crash at one time in all the markets everywhere worldwide. But he says the best thing to do is you don't ever put a pinpointed date on when it's going to happen. So that's one reason he's split into many different areas. But this guy on Zero Hedge, Phoenix, Capital Research, from Capital Research, he says he received a number of emails regarding the fact that stocks continue to rally despite Europe being on the verge of collapse. Once again, investors are forgetting that stocks are the most clueless asset class on the planet. And here's some big warning signs here. Volume is very low. It's fallen to very, very low levels. And yet the stocks are staying way up. Normally in a bull market, when you have high levels in the bull market, that's a healthy sign. When you have high levels of high volume levels, and things are moving up, that looks like a good bull market. But when you have things are staying afloat and the levels are extremely low on volume, that's an uneasy sign where things could crash pretty quickly, unexpectedly. And it says stocks are levitating, he's put it another way, stocks are levitating on a lower and lower volume. And that flies in the face of conventional market action. Bull markets are marked by increasing volume. So volume were to pick up, he says more likely that's going to be the time that stocks will collapse. And if you're looking at this chart, that's about what happened. When volume picked up here, that's when you had to collapse. Volume picked up, collapse. He's pointing this out. It's on the S&P. Volume picked up, collapse, volume picked up, volume picked up. Now we're sitting over here. This is floating up. Next time volume, that's in other words, there's going to be a big sell-off in stocks. Now, the way I look at it, I'm already positioned in the bullion physical metals anyway, so I don't care. To me, this is good news. I got some stocks, but they're basically in silver mining that are doing pretty good. So if silver goes up through the roof, those stocks should go up through the roof. Most of the stocks are going to go down. So I'm not worried about it in the least. But this is going to be a good thing. And if this happens, it says bonds are forecasting an even worse event in 2008. He points out that U.S. Treasuries have in fact already exceeded their all-time highs established during the 2008-2009 crash. In fact, they bounced off their former all-time highs, indicating the resistance is now support. Well, I don't know so much about that as far as the technical on that, but I could think that, since they had an all-time high and they bounced off of it, that might tell you that there might be an imminent crash coming up at one point in time. Um, I think the problem is, and I don't care if people have this problem because I'm buying more physical metals. Um, if people are in the wrong place and they're thinking bonds are a safe place to have money, it's the only place that's safe right now. That's why they're so high in price. People are flocking to them. And I say they're doing a completely wrong thing. But you have to remember, they're going to be the people that are going to pay $500 to $1,000 an ounce for 1 ounce of silver. That's going to be your customer. You're not going to be able to save the world. The thing that's going on is you're going to be in the right place, and they're going to be in the wrong place. The majority is in the wrong place. Now, I would not, I don't mind saying too much of this stuff on YouTube because I don't have that many listeners. And actually, when you start looking at the number of people out there harping on silver versus what goes on in the entire communications industry, there's probably a lot less of them that are harping on silver. A lot less. It talks about the German bonds have actually gone negative, indicating that investors are actually willing to pay to have their capital parked with the government, the German government, based on their reputation for fiscal strength. And he states, this has never happened before. Somehow I think all this BS is going to catch up on itself, and that's a great thing. I tell you, it's a great thing. That's the only way you're going to be able to make that kind of astronomical money on the metals. The likelihood of more juice coming from the Fed is getting lower by the day. Now, that's according to this article. I know what Ben Bernanke says. He's been disappointing people about on the FOMC meeting all the time, saying that they're not going to do QE, and he's talking about the risk of inflation and stuff like that. It's kind of guesswork, but I'm going to use my own head. I think Bernanke is going to do this stuff. You got an election coming up. He's going to do QE. He's already indicating he's doing some of it already in some ways because they're talking about buying up more mortgage debt, more mortgage securities to prop up the housing market. And did read that article. It's very good. But he talks about, this article is basically, this guy, I don't know if he's going to be right or not, but I wouldn't be playing around with any financial instruments in times like this. You're better off with the actual physical metals. But he's talking about shorting the markets here basically as a strategy about surviving a crisis 4 times worse than 2008. That I think is going to come up. My strategy is to stick with the physical metals mainly. And this GainsPayneCapital.com. This is basically a report, an article from them. But, they might have some pretty good strategies. I don't know. But my strategy personally is to stick with the physical metals and ride it out. And I think you do a hell of a lot better. I don't think Bernanke is going to let things crash. And there's a lot of indications like right here that says he's not. This was an article from, I think it was Forbes. And Bernanke claims Fed has no intention of bailing out Europe, but his actions speak otherwise. And says kind of like with little fanfare, very low profile, with very little media coverage, the European Central Bank tapped the Federal Reserve's liquidity swap window for an additional $37.5 billion in the week ended December 29, bringing the outstanding balance to almost $100 billion. So, he's saying one thing, doing another. Because it's very unpopular what he's saying. So he's playing like a politician, we're going to balance the budget, that type of stuff. So, the currency swap program is now 1/6 the size of QE2. Because QE2 was $600 billion. This is almost $100 billion. Which signals the short-term U.S. dollar funding markets remain extremely strained. So, maybe this is why you're seeing, the euro bounce. The euro basically is being bailed out by the Federal Reserve. And this is one reason I don't think this stuff is going down right away. And that's another reason I think deflation's not going to happen. Although it's kind of happening in the short term. So, the euro bouncing like this is making the paper silver look good. So you don't want to, actually at this price, irregardless, it's still low enough that it's a good buy to buy silver, even at $30.30. Actually, even if it's $40.40, it's still a good buy. But because it's going to go up, it's going to go up to astronomical amounts. Wait till, these are the treasury bonds right now, and they're talking that they're already exceeded the 2008 high when everybody panicked and dumped into the bonds and got out of stocks. Well, this is fixing probably to crash. Now, you're talking about a pile of money that is ridiculously large, and you're talking about the silver market, which is extremely small. That's probably where you're going to start seeing some serious gains in silver. Even though the paper market in silver is going to start sucking up some of that money, it's still going to drive the prices up a great deal. But once they try to find some, like, say for instance, they can't deliver on a COMEX or whatever, it's going to start happening, because when you're talking about this kind of money, trying to find a new home, that's it doesn't have too many options to go to. It starts pouring into physical metals. That's when you see the breaking point happen. I know it's been said a million times, but I think the premise is there. It's going to be coming up. And the fact that this is this damn high, and this has actually just occurred in the last several months that it went up this high. So what's going to happen? You're going to see another shoot down here, or maybe lower. Things are being propped up on fears, and people, the majority, are always in the wrong place. So that's the way I look at it. It says he regards, like when they're doing these currency swap program with the European Central Bank. It says they regard this latest expansion of central bank's balance sheet as a form of clandestine quantitative easing. So they are propping up the euro despite what they say. Given the Federal Reserve's track record of aggressive intervention, the recent increase in liquidity swaps is probably only the start of another massive expansion on the Fed's balance sheet. And they believe that the Fed will eventually swap billions, if not trillions of dollars with the ECB, so the European Central Bank can freely lend to its member banks and prop up the euro for some time longer. So that's where you got to really pay attention to, like Mark Faber and Jim Rogers. They're both saying that they're going to keep up this game going for a little longer, and you're probably going to see the euro maybe rise a little bit in the short term before it starts taking its crash downward course. And we saw this back in June of 2010. The euro went to 120 to the dollar, and the dollar index was around 88, 89. And what happened? Everybody in the world was still shorting the euro incorrectly. You know what I was doing? I was buying double leveraged on the U.S. dollar index, that it would go down. And it did. People were betting the other way. So, I think, all this doom and gloom about the euro is too premature. It's not going to happen right away. So, to me, that's probably a good thing, because it's going to keep the silver prices up, and it's going to keep the paper silver prices up, because still for now, paper silver prices are pretty much what the physical silver prices are. You're not getting that much different. You can get somewhat different on collector coins, but you're not going to get that much different. Flipping over to oil, it looks like oil is just choppy going up and down. It's not really doing anything. It's staying in a very tight trading range. It really hasn't, broken through this 100. Now, I don't know if it is going to break through the 100, but I'm betting that way. Majority, I still got a position in oil, but I think it might break through the 100, and when it does, you might see it float all the way down to about 95, right around this position. I don't know if it's going to go down to here again, but I'd be buying around 95 something, around 96, and getting back in it with the expectation that it's going to go back up again. And you know, it is very much a geopolitical driven market, because oil should not be this high a price right now, and it's all over geopolitical tensions in the Middle East. And that is something Lindsey Williams predicted. But I think there's going to be a pullback again. They just need some more, you know, news that there's a glut on the market or whatever. The situation with Iran is settled down, and you'll see it drop back down again. Now, you know, one thing that's a no-brainer is that Europe looks like it's going into a serious recession, so that's going to be very bearish for oil. The only thing that's keeping this up is the Iran deal. So I think the Iran deal is definitely going to play out, where they're going to do some kind of a strike against Iran. They're calling for it. They're definitely going to do it. So what's going to happen is the oil eventually will hit, you know, 140, 150 or more dollars a barrel. I don't know if it's going to stay there long term, but it will hit that. But you'd want to be in there at, you know, getting in there around 95 or something like that, and let it float back up high that way, versus sticking in right here. That's my opinion on that. I've noticed oil always seems to trade around a $10 range, and until it takes off like a rocket. And you know, you want to be in when it takes off like a rocket. But in any case, I'll be in it no matter what. So, you know, I'm kind of looking at these markets a little different. And since now it's 2012, I figure, hey, I don't care about showing profits. So I'm going for still a little bit more. I'm not just holding. So that's a good deal. But anyway, it looks like silver, you know, since the euro's going up, silver's going up. You know, it's silver. They think of it as a industrial commodity, so it's moving up. And you know, it basically, the physical metals, I think when this probably goes up to about, you know, if this doubles this year, I'm almost thinking that the physical metals are probably going to have a little bit more of a premium. I don't think this stuff's going to be that easy to get, because believe that I noticed the last time I saw silver got slammed down in September, I think there was a lot more physical buying going on versus people buying into the SOV. I think there was a lot more physical buying going on. And what's going to bring this market up, I think, is going to be actual true supply and demand. So even though, you know, I think this wasn't discussed much, they're talking about premiums on silver when premium is low on the spot price. But I think when this price of silver goes up to about $60, $70 an ounce this year, there might be a premium on the physical price. Because to bring that up to this level and to hold it there, you might see a lot of money dumping out of bonds and things like that, because there's, you know, people don't know where to put their money anymore. They're going to start looking at this stuff, and they're going to look at the physical. That's when the light bulb's going to start going on more and more in the average American community and global community. And when this stuff goes up on paper double, you might see a lot more premium on the physical market. People aren't thinking that way, but I am. Because I think this stuff is actually going to be tough to get.